So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Max Gonzales. Max leads acquisitions and investor relations for Geometric. Max began his career in the multifamily industry in 2003, where he worked as a broker, working with buyers and sellers of multifamily real estate to achieve their investment goals. 2006, he began working with Fowler Property Acquisitions, a leader in the real estate industry for multiple real estate product types. Fowler Property, he oversaw acquisitions for Arizona, Southern California, and Nevada. For office and multifamily properties, we acquired over $85 million in assets. Max, welcome to the show.
Good to be on. So Fowler was, so in regard to the intro, the more recent place that I did a lot of business, which is the reason that I'm happy to be on, is I also placed money for some pension funds and equity advisors. And, that's on the larger scale, and I guess I'm only bringing that up because it's one thing that I found has been, something that a lot of guests or hosts who've had me as a guest on their podcast have found of interest, because I placed money for some large institutional funds as well. Some, pension funds, some billionaires. And, in some of the large scale, capital placement in the market has been something a lot of guys have found interest in. Fowler Property Acquisitions, that was really where I cut my teeth. And that was a fantastic organization that really, Greg Fowler, who's the CEO and, founder of that organization, I really learned a ton from him. He was really a savant in the industry and someone who, really taught me how to, look at deals and how to, real estate. We often get focused on the flashy, the core buildings, down the street that has the, the nicest amenities and everything else. And to be honest, those are buildings that we generally make, not as much money on as the C plus, C minus to C plus assets in the market that are more workforce housing focused. And within Fowler, they definitely have all the product types now. When I was working for them, really I'm shocked to think about this, 12 years ago now, they were, or 14 years ago now, they were really a group that, could figure out how to make money doing anything. They really were. And, and I really was focused, when I started there on, some of these really rougher properties, which taught me how to make money on some of that stuff versus the really core assets.
That's awesome. Yeah, that's, it's always great when you can, like you said, kind of cut your teeth. You learn that side of things, right? Obviously, a lot has changed in the sense of, the C versus A, the parity or delta is not really as high as it used to be right now currently. And we had a very awesome offline conversation. I had to finally hit record because we almost did a whole podcast offline, which is amazing. And so that led to eventually where I assume you were referring to was Pacific Urban Residential.
That's my more recent place that I worked.
Okay. And that was, like you said, more pension and the institution, which we got into offline, and I would love to continue. I know you'll probably repeat yourself here, but I made a comment that the institutions are probably licking their chops, and you kind of put it into perspective as to how the logic at an institution works versus a retail. So kind of expand on that again.
Sure.
For the listeners.
Yeah, absolutely. The conversation we were having was really the difference between, retail investors' mindsets and the institution's mindsets on capital placement in the market. And, the difference within decision-making for both of those groups is retail investors, they are the owners of the capital they are placing. It's their own money. It's in their bank account. They are the decision makers for it. Versus institutions, where, it's they are in control of the money, but it might be their pensioners' money. If it's a life insurance company, they've got to make sure that the money, they've got enough money to pay out, for large claims. They're also growing that amount of money as a result of the way their industry is structured. Pension funds are the same. They are banking away money for their pensioners, and it is their pensioners' money that they are the stewards of, and they need to grow that money to be able to pay out those retirement accounts for the life of their pensioners. And then the same thing for credit unions who need to be able to have funds available to continue, the operations of their business. But those groups, you end up with very, very intelligent people who are risk adjusting, their investments, but also making sure they're minimizing risk. And it's not the retail investors don't minimize risk, but it's that the institutional investors, they are highly focused on that because they have to be. And that's what they're being paid to do. They're being paid to be good stewards of the money and to dot every I and cross every T. And as a result of that, they become very, very, deep diving into the analytics of any deal that comes across their desk. And generally institutions, I wouldn't say, the retail investors are a little bit more, responsive to what I'll just call flash media news. And, and we're all guilty of that. I'm guilty of that, and where an article comes across my desk and it says, oh, housing crisis is imminent, and then I kind of read into the article and the information isn't even that the housing crisis is imminent. I mean, it might even be that they had a headline that, made me click on it and I read it and I go, wait, this isn't even accurate at all. But, but we see those things, we become very responsive to them. And then for the institutions, they, in doing their own general analysis, because most institutions, they're going to have their own economic studies that they've been completing. They pay for a lot of really advanced data. They've got often in-house statisticians who are paying attention to a lot of these things. And as a result, they take that information and they're going to brace accordingly for what their data has been provided to them. And that might be, and I'm just making this statement up, I don't have any exact statement on this, but okay, hey, there might be a 10% to 30%, decrease in NOI. And maybe that's due to a lot of things. Maybe that's partly, vacancy. Maybe they didn't close their loss to lease closure. Maybe they increased, they renovated units and didn't hit their target rates. But, you've got this point at which, they're bracing for an NOI hit. And those are things that, a sponsor can actually fix within the underwriting of the deal. When I say fix, account for, okay, NOI has dropped. Well, how do we account for this? Well, we account for this by, lowering the purchase price of the deal. Maybe we account for it by increasing reserves because we do expect it to be a temporary problem in the market. But oftentimes institutions, they still want to place money in the market. They do understand there's going to be money lost to inflation. A lot of people who are waiting on the sidelines, this goes for all investors, whether they're retail or institutional, where if we've got inflation at 8%, and 8%, to be honest, is probably low. If you look at how much money has been printed and you say, oh, and inflation's only gone at 8%. I mean, that's just based on the current study about products at the grocery store. That is not going over the fact that they have watered down the amount of money that's in circulation. But the reality is that a lot of investors who are waiting, if it's at 8% at a minimum and you have your money in a bank account for, a year, you've lost 8% of your value of your money. And in that sense, it's really important to actually look at how the investments across the board need to be, about why it's important to have your money actually working for you in a market. And those situations are things that both, retail and institutional investors have to deal with. But the institutions, they just need to have whatever their issue and mitigant was. They've got some issue. Hey, we're worried about collections. We're worried about this. We're worried about cost of, our CapEx going up. But if you can fix for that number within a market, most likely they're still going to look at it and go, okay, hey, wait, we did have this issue, but, we're able to correct for that here. And there are some groups who might just say, hey, they're out across the board. And that happens. There's some groups that have that, and a lot of those decision makers are still looking at those headlines, kind of saying, hey, you know what, we just want to be out until this next time. But for the most part, most of those groups still want to find good deals. And many of them, I think you use the term licking their chops. That's accurate. That's accurate. They are. I mean, there's a point at which, the market's going to flip the other way. And a lot of the big capital that's available in the market is going to come flooding back in and say, hey, now it's time to, invest now that we know that we are, you don't have as much tumultuousness or uncertainty going forward. Because right now, the biggest issues people are dealing with is just uncertainty in the market as a result of the debt markets being as crazy as they are with impending interest rates continuing to go up. And what's going to happen in the economy with the jobs market. With inflation as high as it is, and and I guess I'll go into this again, but the government can't stop inflation by raising interest rates. Those are I hear that statement a lot, but those things are not correlated directly. they can slow down the increase in prices as a result of moving the pain point. And in short, if you've got a supply and demand curve, demand meets supply. If you've got increased demand, then you shorten supply. As a result of not having enough supply, prices go up. Well, their argument is they are slowing demand on the aggregate of the entire country, meaning that if demand is lessened, then supply will increase. And as a result of supply increasing, then you have decreases in prices. Now, that works on an economic chart for supply and demand of goods manufactured that are in short supply. But as far as inflation goes, they have watered down the value of the money internationally. It's happened in the US, it's happened all over the world. They printed more. And as a result, goods are going to continue increasing in price. They can move the pain point and they can slow this process down. More unemployment will eventually result in companies hiring, new employees at higher wages as a result of increased cost of living, and that will, in a sense, recorrect some of the imbalance that's happening in the market. But in short, inflation's here. It's here. It's happened. They printed out this much money. They printed out a ton of money during the 2008 recession, trying to get the country back on, and we saw a massive bull run in 2012 to 21. That was a result of, there being so much money that was printed looking for a home. And a lot of that eventually goes back to infrastructure, which is real estate. And we're going to see the same thing. The same thing's going to happen as a result of as much money has been printed on the market. So people ask me, when's the right time to invest? And, my personal stock manager, I ask him that question, and it's funny because I ask him, and he goes, Max, you work in investments, you can't time the market.
Right.
And he's right. You timing the market is always something that's going to be, it's going to be something that we're all going to struggle with in some regard. And what I would say really is the better thing to do is within real estate is just to make sure that the investment has been thoroughly vetted and any of these issues that I'm describing have been addressed. And a good sponsor should address them. If I'm ever on a call with an investor and they ask me something I don't know the answer to, I'll probably cancel the rest of my calls and be like, hey, I got to figure out the answer to this question because this guy stumped me on something that I didn't know. Normally that doesn't, I shouldn't say normally doesn't occur. It doesn't occur. If I don't have an answer to any question that an investor could ask me on one of our deals, then, we're not going out to talk to investors because we're like, hey, we need an answer, whatever this question is.
Right. Right.
And, and that's, the core of any investment, to make sure that, those I's have been dotted, the T's have been crossed, and making sure that, we're paying, proper attention to always be good stewards of our investors' money. Because that's what it comes down to. We are always wanting to make sure that we are investing well on behalf of our investors. And as a result of that, anything that we're looking at right now, we're being a lot more conservative within underwriting. Last year it was appropriate to use a 5% for rent growth. It was okay to, kind of say, hey, we've got this exit cap that's a slower number. And those are things now that we're looking at it. We don't know what exit cap we're going to be at for a lot of these deals. People are still kind of like, oh, I'm using a 6% exit cap. That should be good. And my answer is, well, it might not be. We were at, 7% cap rates for a lot of markets in the US in 2019. We saw those get compressed down to sub 5 in most US markets. And as a result of that, a wild increase in value as a result of, capital being so cheap and so affordable, could it go the other way? And the answer is yes. But could it also go up in parity with, increasing inflation and rent growth? And the answer is also yes. We could see that we end up with rent growth. And this is a philosophical, hey, we don't know. But we could see rent growth at 10% for the next 5 years. And then we could see cap rates all of a sudden being at 7.5. We don't know that. We're not sure. But within some of the deals that we're looking at, we're always making sure that we can hold for a 10-year period. If we have to hold for 10 years, can we do so if the reality is the debt markets are not available to do so within, a 5-year period? And those are things that we're using to kind of make sure that we're still taking care of these deals. I am a long-term, very staunch believer in the real estate market. I believe that all of the real estate everywhere is undervalued. All of it. We are 15 million units short in the United States of how much housing we have. The supply chain issues are not going to catch up with the need for supply. The cost of building new housing is going to continue to increase along with these costs that we're kind of describing here. And for those reasons, I'm a firm believer that shelter, which is, your real estate in general, will
Right.
forever be in demand and be something that's a good asset class to be investing capital in.
Yeah, absolutely. I honestly couldn't agree more there. And it is fascinating, right, to kind of see how things, will transpire, because like you mentioned earlier, so much uncertainty happening right now that people are sitting on the sidelines and kind of waiting to see if we get a little bit more clarity. My question is, what does that clarity look like, right? What signal are you waiting for that's going to let you know that, oh, that was the bottom, or, it's good to start buying again, And so from your perspective, what do you see as sort of that signal, if there is one, that, we should get
Y-
back in? And
By
because
the
for
time,
me,
by the
I
time
see
it,
it as, yeah, go ahead.
no, sorry, I don't want to interrupt you.
Yeah, I was just going to say, for me, I see it as, you mentioned the stock market earlier, right? You dollar cost average the stock market, right? Your stock portfolio along the way, or if you're doing it correctly, that's certainly one strategy. You should be using crypto, same thing. But, you know, not a lot of people talk about that in real estate, but that's also, a great way for real estate as well, because if you're in this game long enough, and like you said, long-term outlook, there's going to be some things in there that don't go the way you want, right? But those are, hopefully outdone by the ones that are done correctly, So I guess my question is there a signal that you're waiting for that, since we're on the institutional side, that they typically look for in a situation like this?
By the time the signal happens, you've probably missed the wave or at the early side of the wave. Really, if that's the case, by the time you're like, hey, I should get in. And within, investments, and stocks are a somewhat good, analogy for this, but, within real estate, it shouldn't be one investment. Hey, I put all my money into this one deal. It should be, hey, I put 50K in this deal, 100K in this other deal, another 175K in this deal over here. And as a result of doing so, with spreading, those dollars around into different investments, you are going to end up with a portfolio that is going to have more winners than, I don't want to say losers, but more winners than deals that performed at the underwritten target amounts. And could they perform poorly? Not out of the question. Make sure that, whatever you're investing in, you've vetted those investments across the board. But, but my point is, if you already are in the market and there are new deals coming up and you're working with some sponsors or some other individuals who are doing more deals, you'll still have opportunity to do those deals. Hey, we're going to sell this deal. We're going to move our money into this other deal over here. And those are things, if you already have your money placed into the market, you're going to start taking benefits of those long-term gains as a result of being in the market. Not saying, hey, I'm putting all my squirreled money away into this one individual deal and hopefully that goes well. And if I had waited 8 months, and that one particular banked amount of money would have done better had I waited 8 months. It should be looked at as a portfolio, and those portfolios start. So anyone who's like hasn't invested yet, and you're wondering when you should invest, start investing. Get some out here, get some out there. And once that happens, the investor becomes more experienced. They start paying attention to more of these numbers. They've got a little more skin in the game. Anyone who ever, gambles a little bit on some sports, man, you'll find out how much more engaged you are in sports and paying attention to the score if you've got a little bit of money in there.
Yep.
And within real estate, I shouldn't really use the analogy of gambling, but my point is that, investors become educated, and as a result of becoming educated, they become more confident in seeing how assets are performing. We offer a lot of benefits outside of just the investment in the real estate asset itself, which, is correlated to depreciation of the assets. People when they get their K1s from us, are always pleased to see how much they've got an offset of their other taxes as a result of owning real estate. And, and within, timing the market or when that golden signal is, more assets is a benefit. And and the more assets you have, the more playing cards that anyone is able to have and then to play at a particular time that is needed. The more circles you're in with investors, the more sponsors, the more ability you have to be able to choose which investments you do want to have your money into. But I've met guys who said, yeah, I got into the industry and I wanted to invest in 3-cap triple net deals that were fixed, 3-cap. There was no value add attached to the deal. It was just a 3-cap. And I talked to this guy and I was like, well, that's a horrible investment. I don't think you're not going to make any investment at all. And he goes, yeah, it's my fourth one. The first two had the tenants turnover, and we had a really low basis in the building. A new tenant moved in, and all of a sudden our basis is now a 7 cap for a triple net deal. And I was like, oh my God, what? That's fantastic. And he was like, yeah, I didn't expect it. And he didn't. But the point was, we did what he should, which is that he got his money out to invest and grow in value. And he happened to have a sooner payday in that particular tenant in 2 of those locations had vacated. But he got kind of new. He was like, hey, look, I bought this investment. It was I think he had a 20-year horizon line for the investment for the dollars out, and he knew that within about 10 years he was going to see turnover. And it turned out that he got that a lot sooner than that. And as a result, he was able to really make a significantly larger return on his initial invested capital. And my point is, within these deals, on our assets very specifically, we beat them up. I have, low rent growth put in. I have reserves, over accounting for potential loss of NOI. We're going to look at, what debt we've got to make sure that we can, withstand a long-term hold. And, and we're expecting to, and all those things, when I say beat them up, was with the expectation of outperforming our numbers. That's the hope. We don't want to promise that to the investors because we don't want to promise anything. Hey, this is an investment, and once we're on the bus, we need to make the best decisions for everybody. But in regards to how we're underwriting these buildings, hey, we need to be good stewards of the money, and we need to point out the problems. Point them out. Not like, hey, don't pay attention to that. That's the problem. That's this thing, and we're paying attention to it, and that's why. Within our business plans, and we write a custom business plan for every asset. And some people are like, oh, what's your normal deal? And we can kind of describe what right. An optimal deal looks like. But every business plan that we write is different from building to building to building to match the specific investment goals for that particular asset.
Yeah.
And in so doing, those problems have a flashlight on them. Whatever it is, the unit mix isn't, the ideal one for the market. We've got some situation where there's some new buildings going up down the street, and we're worried about supplying the market, but we need to pay attention to what the demand is in the market for new housing, which is why the new product's going in, and how much of a discount are we to the new product. There's a lot that we focus on to be able to address those problems, or I don't really want to call them problems, those individual building characteristics that need to be paid attention to. And that is, and that's, I think, the biggest focus for any, investor who's out there looking. There's a lot of, market factors going on, but the reality is that the buildings that were purchased in, there weren't very many buildings purchased in 2010 and 11. The market was really had a lot of very low volume during that point in time. And people talk about the, Jonny, stop me at any time, as I ramble on these things.
I love it.
But the people talk about the 2008 crash, there's a real estate crash. It wasn't a real estate crash. It was a liquidity crisis. Mm-hmm. No one could get new debt on their buildings as a result of the debt facilities going away. They couldn't refi, and new buyers couldn't get attractive debt to be able to pay out as much money as was needed to get the sellers out. And that was tied to unemployment. And, and as a result of that, the market took a big hit, but in the rearview mirror, there were very struggled deals. The few deals that came up during 2010 and 11, they were trading for like 3 caps because, there was super low supply, and these buildings came out and they had low collections, and people were climbing over each other because they had money that still needed a place to go. And they said, oh, here's this building, and, we need to place capital, and we know the market's going to come back, but they were kind of really worried about it. They had to do all these things I'm addressing in regards to bridging a period of 18 months to kind of say, hey, we're going to weather through the storm. And on the backside, every one of those deals turned out to be a fantastic buy. It did.
Yep.
And, and within this current phase of the market, the biggest difference with this one is the government is intentionally doing it. And I don't want to say that's great. I don't want to say that I'm in total agreement of the way of their logic within doing so, but I will say it's better than an uncontrolled crash where things are happening outside of control. I don't want to say our country's being captained well. I don't want to go that far with some of these statements, but I will say this is intentional. Yeah. This is intentional, and as a result of it being intentional, there is some control within the process that they are the problems that are being created with intentional plan to actually pull out the country from the recession they're intentionally creating. And
Yeah.
those factors are the ones that everyone's kind of trying to figure out. We were at such historically low rates, in 2021, that, it was just kind of this question of, how, where are rates going to go down to after they're done raising them? Because they're expected to do a couple more rate hikes this year, most likely, probably some additional ones in first quarter of 23. And, in those rate hikes, it's not going to be like all of a sudden, oh, inflation got tamed down, and now as a result of this, we're going to drop rates immediately. They'll probably stay at those higher levels for a while. There'll be a lag in the market. They'll raise them to wherever they did. They'll stay there for 4 months, 5 months, 8 months, hopefully not a year, but we'll find out. And then they'll start to lower them slowly. And, in that lowering of them, the question is, where is that lowering going to be? Is it going to be, 5.5? Is it going to be 6? Where is that new, I don't even want to call it a floor. Because there is no floor. There is no, what are regular interest rates? That kind of idea doesn't exist. And those of us in the market have to deal with all of those factors for interest rates across the board of just, hey, these are the interest rates, and we have to work through these rates to create good investment opportunities for our investors.
Absolutely. I mean, you look back historically. Sorry, I'll just jump in here.
No, please do. I'm sorry, I'm rambling
quick
here.
Anecdote. No, I love it. You look back historically, right? And, you made a perfect point, like what are normal rates, right? But you look back, you've got the 80s and, interest rates were double what they are now, almost triple. And opportunities were still available. You talked to, people who were,
what they called them? The raging 80s.
Yeah, exactly.
The raging 80s. That's what they called them, because they were raging. And it's, sorry, go ahead.
No, that was really my point, right? Is, like you said, we're in for more interest rate hikes. I think, like you said, at least one more in November, if not another one, definitely some coming Q1 of 23. And I'm of the same philosophy where they're going to get them to a certain point. I'm not really sure what indicator they're waiting to kind of trigger, but then they'll leave them there, let everything kind of catch up, right? That includes obviously, residential, commercial, everything kind of hitting the plateau and or, coming down to some degree. And then they'll start unwinding them. I guess I'm curious, and I'll let you continue. And then, kind of on the back end, do you foresee the lowering of the rates at the same rate they've been raising them, or do you think it'll be smaller?
It'll be smaller. It'll be smaller. Well, I mean, if a Republican gets into office, that's really going to take the cap off of things again. And that's, and I got to say, I don't know what's going to happen. I mean, I hate to talk about politics on these things because, it's such a hotbed of problems within our current, society to talk about these issues. And actually, I guess let's talk about politics a little bit. The majority of us are in the middle as far as being moderates, I'd actually say. And unfortunately, it's the fanatics that are on the far spectrums, the fanatic liberal and the fanatic conservatives. And most people are not that fanatic one way or the other. Most people are somewhere in the middle. And unfortunately, they have to pick a fanatic because that's our two-party system and what it allows us, which I'd harp more on just our two-party system.
We could do a whole episode just on that.
We could. I know. We could talk about that a lot. And on the conservative side, if that party gets into office, I mean, they are generally, known to be more, focused on wealth growth as opposed to what I'll kind of describe as scarcity mindset, which is what the liberal side has, which is a little more welfare state mentality. And, and they both have their benefits and, benefits to society and their drawbacks. But the conservative side generally is the one that, uncaps a lot of those, restrictions that are on the market to truly, hit the gas pedal and really get everything moving again. And we'll see what happens within this next election. The country's got a lot of situations that need to be addressed, and everyone's kind of trying to figure out how to get them addressed. And, no one quite knows how to get those things worked through. And it's rough. I mean, I guess I don't want to go into too much more because I don't want to get into the philosophical side of it. But, we'll see what happens in that next, in the next election and see where those things actually go.
Yeah, I think, let's see, midterms are, wait,
This
this
November.
November, right?
Yeah.
So I think that will be a huge either shift or some kind of indication. I think that could be some sort of signal. Obviously, the Fed operates, independent of that, but, certainly whoever is in charge is obviously in their ear. And you obviously were about to make a point about conservatives getting in office and kind of taking the cap off. Obviously, with a conservative in office, they lean a little bit more toward, the business side of things. There's obviously the side that we're in a little bit more. So, you kind of have this sort of teeter totter of like, we don't really know what's going to happen.
Yeah, it's pretty accurate, and I don't know. And I don't even want to say I'm pro one way or the other. I kind of meant my original statement of like kind of these fanatics where we kind of have to, pick a fanatic on one side or the other to kind of get behind, which is really, it's upsetting to me more than anything else, because I think that a lot of the issues within the country could be, fixed by a lot more of a moderate, process. And instead, we end up picking between these two that are just such polar opposites that,
Opposites.
yeah, that does really cause a problem as a result of them just not working together. And, those are things I get concerned about. Global playing field is one that's, I think outside of the real estate space and the market, I mean, I'm pretty concerned on global markets. That's one that's a hot button for me that I get very kind of like, concerned about. But at the same time, you can't not grow the money. That's the reality is you can't not grow the money. You can't, have, the bury the money mindset, because, in our society that will lose. That's one thing that we know is that if you're not investing your money, you will get left behind. And, a lot of us, even the corporate space, for you and for me, working on a corporate job, they, it's not as, you have to figure out how to be a good squirrel. And I'm not meaning squirrel, meaning bury your money, but invest, get the money out, grow the wealth, do the things that you need to do to be able to, to exist in the United States, which is a very, we all have to work pretty hard here. The hustle culture is very correlated with the demand of doing so in this environment that we all live in. And, and we're all, as a result, figuring out how to be more productive and, how to get more things done. And, technology has really enabled us to do a lot more of that. I guess that's another philosophical topic we get into on some other level.
Yeah. And on the, as a double-edged sword, it's also driven us further apart, right? I mean, I remember, not that I'm that old, I'm 32, but I remember, turning 18, one thing I was looking forward to was being able to vote. So I got not involved in politics, but started to pay attention, right? And
Sure.
You could sit at a table with two opposing sides and eat dinner and have a discussion. Now it's like you said, the fanatics have really sort of stolen it away, and it no longer feels like you can disagree. Now I don't want to get too philosophical either, but that is one concern. And I like the point you made where a moderate approach would ironically be really, the shift that we need, where, sort of a compromise on some of these things, because there is a compromise on a lot of these issues.
Yeah. And, yeah. And, the next 20 years are really going to be a very wild time. The age of Senate and Congress, when I say 20 years, there's going to be a lot of turnover. There's going to be a lot of turnover. There's also going to be, a massive wealth transfer from, the boomer generation, who's going to be, passing, wealth on to, the next generation of their heirs. And, and those things are really going to create a very, very drastic paradigm shift that we haven't seen previously. And, I'm calling it a paradigm shift, saying it's going to happen overnight. But, over the course of 20 years, it's going to be a very, very interesting time to see how those new decision makers within government and also new decision makers with money are going to be, handling their dollars. And, actually, there was one comment I was trying to remember what I was going to say, but, there's a quote I heard recently that I really liked, which was, money travels to where it's treated best. And, and that is kind of a factor that we have really noticed very much within our country in regards to, a lot of the red states versus a lot of the blue states. We do invest in California. I am a big believer in the California market. I do think California is a fantastic location for investing. And anyone who wants to connect with me, I'm very available via my website, Instagram. But the reality is that, the rent control market within California has done nothing but increase the prices of the real estate. That's the reality of it. Prices have continued for the value of the real estate have continued to shoot up as a result of regulatory regulatory oversight that's come into the state. And they are actually officially, I will say, working harder on allowing more units to be built. They've started allowing zoning for particular locations to not need to be changed to multifamily to get through zoning. There used to be a process by which you had to change zoning from retail to multifamily to have that done. And now there's some new regulation that says there's some loopholes that you can get through to be able to build more housing. They've started allowing ADUs. It's a lot of the stuff that they're finally starting to really allow to up the amount of supply in the California market. And that's all going to take a lot of time, and it's also very expensive, as I've mentioned previously, with cost of construction. But the California market, it's seen a big growth as a result of those things. But the markets that have seen the bigger increases in values have really been a lot of the red states. Texas, Arizona, Arizona's kind of purple right now, but Arizona, Texas, Florida, these are markets that are, top markets in the US, and they are because, the money that goes to these locations is treated well. And you see how big some of these metropolises are becoming as a result of new investor demand that's going into those locations. Which brings in jobs, and it brings in, more people who want to be part of a, growing city. And those are things that, we definitely pay attention to on the investment side. And because we want to be places where we can continue growing capital, and within rent control and within this just massively increasing rental rates in the market in general. I'm never an advocate of evicting anyone. I don't like it. I don't. We hope we never have to do it. There's been a lot of taking advantage of processes that have put in place in some of these blue states whereby in which you have renters who just decide they don't want to pay rent anymore, and if someone really digs their heels in, it can take a year to get someone out. And the individual who's at the property, they don't recognize that someone else is actually still paying their rent. They don't actually recognize that someone else is actually, there's a debt on the building, and that the fact that they're not paying, someone else is still paying out the cost of that delta that they are not paying. And that's something that a lot of renters just they don't recognize that. They just see it as a different system, or I don't know quite how they rationalize some of those things. But my point is a lot of those red states, they've seen a massive boom as a result of still being landlord friendly. And also those are markets where you still see there's the most growth. They don't penalize new builds. They say, hey, we want new units built. And as a result of that, it creates better systems for supply and demand, which do benefit the actual renter at the end, because the renter is able to have, supply and demand factors that do match. So they're able to get an appropriate rate. In California, the supply is just so short still. It really is. And I just see it constantly.
Yeah. You have that mixed with, income friendly states, right? You have Tennessee and Texas, right, where there's no state income tax. And, as millennials get older, and, obviously some of them starting to get into the home buying phase, I bought a house 3.5 years ago, I was definitely early.
Good timing.
For my generation. But, a lot of them still wanting to be on the rental side of things, right? Not wanting to own a home, but recognizing that they can go somewhere where they can, reduce their tax exposure, right? Just by living in a certain state, and, happens to be a red state, right? Just along the same lines as you, where you have all of these things happening economically, they're more business friendly, which, like you said, more open to development and, helping the supply issue, all of that together, makes and really, the economics are really starting to show it.
Yeah. One thing to talk about single family home buying, the corporations are going to continue buying single family homes. and they are going to continue controlling that segment of the market as a result of recognizing that they're actually getting relatively good cap rates on a portfolios of properties that are single family. Cash flowing houses, literally houses. And, and their resale value on the houses are not based on, they're based on the ARV value on the open market versus, capitalized value on the backside, which maybe that'll shift. But the reality is that the corporations are continue buying more houses. The stat that I've heard for majority of 21 and still into 22 is that, it's something like 20 to 25% of home sales nationally are being purchased by a corporation. And as a result of doing so, they're reducing the amount of supply for regular, owner-occupied owners to be able to own real estate. And as a result of that, those prices are also going to continue going up. They are. And, and to anyone who's listening, there's a lot of, stuff out there that says, oh, if you're investing, don't buy your own home. Your own home is a bad investment, and you should have your money out. I totally disagree with that. I really do. And the reason I disagree with that is because once you actually purchase a home, you're locking in your cost of living. You cannot remove your cost of living from your balance sheet for a personal plan of your finances. You will always have to pay money to have a roof over your head. And as a lot of people have now seen, your rent can keep going up. But if you get into a mortgage for a piece of real estate on a long-term fixed place, well, then you're fixing your cost of living. And instead of having it go towards, rent, it's going towards the actual, paying off of the actual house. And in so doing, the piece of real estate will eventually grow in value with equity. You move into a new home. You'll take that equity with you. You'll move into the new home, and you'll probably get the same amount of debt on the new place. So maybe you bought a place that was 500. You lived in it for 3 years. You sold it for 700. But your debt amount, once you took that equity to your new house, maybe stayed the same. So now you bought a house that's even larger than that, but you have the same amount of mortgage on the new real estate, and your cost of living is still the same, even though you've moved into a bigger place. And in a lot of investment guys, they'll say, oh, if you get your money out into other investments and you're getting 15% or 20% on your money, then great. But the reality is in real estate, we find out that's pretty hard to do. It's pretty hard to do, and you still have that cost of living to have. And most people, when they say, well, I know it's a better investment if I do this other, put money into these investments rather than my personal home. That's if you're doing it. A lot of people will say oh, well, the books say this, but if you don't do it, it doesn't work.
Right.
And if you have to pay to live in your current place, then do so. I'm a big advocate of owning your own home. And the reason is because it is an investment class, and you can have seen that as a result of BlackRock and these other groups, buying up single family homes. So, and a lot of people, they kind of decry the difficulties with, purchasing a home. Oh, it's really hard. It's really expensive. Everyone who's bought a house knows. And they had to at some point, like when you bought that house 3 years ago, I bet it wasn't easy. I bet it was really hard. I bet you had to really figure it out.
Yeah, absolutely.
Yeah. It is never easy. And this goes back to the timing of the market. It's never easy. It's always hard. And everyone who did it had to figure out how to make it work with whatever they could to do so.
1,000%. I had people telling me I was an idiot. They're like, the market's coming back down anytime now. Right.
Yeah, the issue with their logic on saying the market's going to come back down is that the markets come back down because no one has any money. And some people have this thought that, oh, well, the market's going to come down, and that they as the sole individual are going to have money when no one else does. And the reality is that no one has money together at the same time, because in this case right now, debt cost of capital has gone way up. The price of your debt is more expensive. And as a result of that, people are now realizing, well, their buying power is way reduced as a result. That's why prices are lower. So when people say things like, oh, well, the market's going to crash, and then I'm going to come in and swoop up all the real estate, that is not, it just does not work that way. It doesn't work that way because the prices are decreased as a result of the entire economy taking a hit, not as a result of, there being some localized little reason that, one piece of property came down in value.
I know. It's crazy. Fascinating. Well, Max, this has been absolutely incredible. I've appreciated all of this insight and your perspective. You're obviously very knowledgeable on this stuff. But we will wind down here. We'll jump to the final five. First question, best advice you've gotten from a mentor?
Gosh, Johnny, you're going to stump me on this one. Best advice I got from a mentor, I'll reference, the president of Fowler Property Acquisitions, which is Ben Cattell. And the best advice he gave me was to listen. listen and to make sure that I could, I knew my audience. And, I'm a little coffeed up right now, so I'm talking a lot, but when we're in meetings with guys, I really, really try to focus on what they're saying so that I can pay attention to the problems that we're hoping to fix. And that goes back to sales in general. But I think that's probably the best advice a mentor ever gave me. I think when I was young, when I was working with Ben, so, when you're right out of school and you're working your first couple of years, and we're also ego filled and think we know the world until we get slapped around a lot, get punched in the face a lot.
Yep.
And then, the market hits us, and then, eventually we become these more, seasoned individuals with, a lot more sage, long-term advice. That was a really big one. It was a really big one. And it because, the industry is a people industry, and we all want to work with people that we like. And the way that we find people we like is by listening to them, and finding out their situations, where they came from. I think that was my biggest one.
Couldn't agree more. Listening is truly a skill, right? Because we all hear, but listening is very different. What is it about your career that makes you feel like you're fulfilling your why?
What is my career? My brain in my career now, I used to be on the corporate side, and I was a cog in a wheel, really best way I'll say it. When you're on the corporate side and you're a W-2, it might be well-paid W-2s, but you're still doing a very specific job for an organization. And, in the W-2 role, I really felt like my brain was no longer progressing. And I mean that. I was very good at what I was doing. I was using my brain all the time. It was very, I loved the work that I did. I loved the companies I worked with, but I was in a very narrow box of the work that I did. Meaning that I was in acquisitions and I was constantly looking for new deals, negotiating out deals, but I wasn't expanding my knowledge base based on the other tasks that you have to do as an entrepreneur. Mm-hmm. And, and in this role now, I'm wearing every hat. We've got a team of 5 with me at the helm, and I have to, be doing marketing, asset management, construction management, and I've got help with all of these tasks, but all of the stuff, really ends up landing on, my shoulders to kind of look over and oversee. And within those things, we just have to, and I don't want to take credit for all those roles either. All the people that are on our teams are doing those things, but my point is you got to learn everything. You got to learn everything, and we got to constantly, figure out how to do things that I didn't previously know how to do. And in reality, that's been the biggest thing we say fulfilling my goals, because I just felt like when I was on the corporate side, like I just felt like I stopped progressing. I felt like I wasn't learning anything new. I felt like I was just doing the same stuff, and that hurt, for me very much as someone who really wants to achieve on the inside. So that's what I would say.
I love it. Yeah, it's so true. Favorite non-real estate or investment related book?
Harry Potter.
Nice. I love it.
Where the red fern grows. Gosh, non-real estate investment book that I've loved. Looking over at my books here. You mean a business book in general, or not? Just not real estate
self-help. Yeah, either one.
Business self-help. I really loved Atomic Habits.
Great book.
Yeah, Think and Grow Rich is a really great one. How to Win Friends and Influence People. I'm actually looking over at my book list. How to Win Friends and Influence People is one that I try to read almost every other year. And Atomic Habits is one that I really advocate as well. I think that's a really fantastic book, because it just helps you remember how to change and how to do things that are different. We all have ways we want to improve, and those are some of the really good ones. How to Win Friends and Influence People. That's a really great classic. And that one is an educational book on process, how to work with people. And then Think and Grow Rich is really a great one for mindset. Really, hey, where's your mindset within your business? Where's your mindset within what you're doing from day to day? And, where's your purpose?
Absolutely. If you could have any superpower, what would it be?
Gosh, did I get an email of these questions beforehand?
No,
if I could have any
surprised
superpower,
on purpose. We love organic.
Gosh, this goes into the and it has to be an actual superpower versus like,
I mean, if you're into superheroes, you can pick one. If not, some people use like life skills. A lot of people are
I'm gonna go altruistic on this. I'm gonna go Storm for weather, so that I don't do it. Because if I say anything that's like, oh, I'll get people to say yes to sign contracts, that just sounds so skeezy. If I would do weather, then I could actually make it rain in places where it's needed to grow crops and fix drought issues. So I'm going to go on the altruistic side for this particular question, because other people are like, oh, I want to fly or whatever. I don't
Yeah,
know.
that's
I don't,
mine. So
I mean, that sounds really fun, but I think if I was able to really, go to certain locations that are drought constant and, actually, create, clean water and, fix, the caps with, our global warming issues, I'd go with that one.
I love it. That's awesome. Cool. Last one. What's the best way for people to get a hold of you and learn more?
Best way to get a hold of me, our website, www.geometricre.com, and my Instagram _Max Gonzales _. And, and I love connecting with people. We do these podcasts to get in contact with more people in the market. If anyone who's out there and they've got a deal, and they're like, hey, I think I got this piece of real estate, I'm trying to figure out how to make it work, call me. I love working with guys on these deals. I've got several guys I work with in different places in the US where I work with them. We meet once a week. We talk about what deals they're working on. And we have, a handshake agreement that, once we find one that works, that, we'll work together on these deals. Multifamily is absolutely a team sport. Jonny, you raise capital for deals, you partner with guys to do so. And, so if anyone is out there and they need some assistance with figuring out a deal and they need to figure out capital, call me up. I'm very available. I love working with guys, and we can help you to, get into ownership of an asset and also get some training involved. A lot of people call me and they, how do I underwrite real estate? And the answer is, it's just not a 5-minute call. It's a lot of work, and it's so much work, in fact, that generally I tell people, start working with, guys that they know who have a knowledge base in existence, and they can kind of work alongside with them on a real world deal. That's the best education that I would advocate for. Absolutely. And if we can find someone who's a boots on the ground person in a local market who's found a deal, we love it. So that's something we're absolutely looking to find.
Sweet. We'll link the website in the show notes, make it super easy. Max, again, cannot thank you enough for your time. This has been awesome.
Jonny, thanks so much. So glad to be on here.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.